you look at the charts, 2550 is a breakout. But if you listen to somebody like Michael Oliver, who charts momentum rather than price per se, the breakout is about $1 below that, around 24.40. And if it breaks above that on the momentum basis, then you might want to watch for a very strong, quick move of $5 to $10 above that in a fairly short period of time, days or weeks. And that's the sort of thing I'm watching for.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Smith from the Morgan Report. David, thank you so much for joining us today.
It's great to be back, Elijah.
It's great to have you. Now, you recently wrote an article regarding gold and silver, and especially gold, and you mentioned how a lot of people think that the gold price is quite volatile. But if you look at the last 20 years, it has actually gone up more than 80% of the time for each year. So if you want to share that and kind of explain for our viewers, why do you think that gold is insurance, and why is it such a stable asset?
Well, there's a practical and an emotional reason why gold and silver really should be looked at as insurance first, profit second. First of all, the practical matter is that a lot of people hold and should hold gold as an insurance policy against the degradation of their other assets, either through the aspect of inflation, which constantly eats away at our paper money, our fiat money, not to mention in times when the stock market is in a downtrend, gold tends to be countercyclical, and after an initial drop, it will tend to rise during times of great discord, like it did in 2009, when it was the only asset, I believe, that year that was up in late 2008 and early 2009, only by about 4%, but everything else was down. So an insurance policy, I think that works very well. I think we're going to be facing big enough moves going forward here in the reasonably near future, going out over several years, that the profit motive is going to be something that people want to consider as well, too. I think the potential is there for a very large amount of profit as we move into a very big leg of the secular bull run, which has been going on since about 2002 in gold and silver. And the emotional reason for looking at the metals, especially gold, as insurance is that you will be less likely to sell in a panic because your emotions are a lot less. You've accepted the fact that you're buying it as insurance, and we don't sell insurance the first time that something goes the other way for a little bit. We go, hey, I'm glad I have the insurance. And so this tends to keep you calm, and you don't even think about selling, especially if you're not on margin and if you're not doing futures contracts or something like that. So it serves a psychological and a practical means for holding them.
Now, you mentioned how gold and silver are not very volatile. Over the long term, that is correct. If you look like year to year, we have, although this year, seen amazing price swings in both gold and silver. And we were talking before the interview how you see this actually, what happened in 1979, actually, right before the blow off top for both gold and silver. This is the same kind of price action we were seeing, up and down real fast. Can you explain what we're seeing right now? And does that signal that we might be going towards a blow off top soon?
Yes, let me get back in a minute to with the first part of your comment about gold and silver not being too volatile or how volatile. But let me address the price blocks, what I would call price blocks, which are starting to take place now. And it's kind of funny. I just thought of this today, and I referred to 1979 when silver started its move from, actually it had gone in late 78, I believe, from about $6 to $10 or $11 and then it got up around $12, and that's when it really started taking off. And in the process of getting up there, instead of seeing 10 cents either way during the day, you started seeing 20 cents, and then 40 cents, and then 60 cents. And finally, when it broke out and went up from, say, 12 to 20, and then it did several other impulse legs up to 50, the blocks got bigger. So you might trade in a $2 range over a period of several weeks, and then a $5 range. And so I'm seeing the same sort of thing here now. For example, today, silver was down about 1 point, about 50 cents or so. Now, that's considered to be a pretty good sized move one way or the other, but I think we're going to see a lot of those kind of moves, both up and down. And if you were to draw blocks around several days or several weeks of price action going forward, I think you would find them to be in rectangular formations on the way to breaking out to higher levels. And that's the sense that I'm getting, is that they're building up a lot of energy, which is, this sideways to slightly down pattern has gone on for about a year and a half now. But that energy is building up for a big move. And according to the Bible on technical charting, when the metals break out of a triangle, 2/3 of the time they break in the direction of the preceding trend. So gold and silver are in a secular uptrend now. The odds are 65 to 70% that move will be higher. Sometimes you can have a fake out to the downside, and it could break lower, but it doesn't mean it's going to drop down that much. For example, if silver were to break down in this kind of a pattern, it might go to 20 or 19 or even 18, but it wouldn't stay there very long, I don't believe. But 22 seems to be pretty solid support right now. It doesn't like to stay much below that. So it's banging around between 22 and essentially about 25.50. And if you look at the charts, 25.50 is a breakout. But if you listen to somebody like Michael Oliver, who charts momentum rather than price per se, the breakout is about $1 below that, around 24.40. And if it breaks above that on a momentum basis, then you might want to watch for a very strong, quick move of $5 to $10 above that in a fairly short period of time, days or weeks. And that's the sort of thing I'm watching for. So I want to have enough metal, and I want to have enough mining stocks so that I'm not scrambling to get the positions that I want when the volatility increases and the potential price profit starts declining for me by waiting around until the market does exactly what I thought it would do.
What is also paralleling what happened in the late 70s, not just the technical aspect, but also the fundamentals in the economy, inflation, and all that. We saw stagflation, a weakened economy in the 70s amid inflation, and this was incredibly bullish for gold. So your perspective on that, how does what we're seeing today mirror that, and even more so?
Elijah, we're seeing stagflation again here in 2022. And I remember this very distinctly. I think that's where the term was really coined, was in the late 1970s. And that condition was relatively high inflation and uneven business conditions. Some sectors did reasonably well, others not so well. There were supply problems. It was difficult for people to price what something should be because the inflation kept moving things up. And I remember working in a grocery store in the old days before computers and all this during that time. And we would use lemon juice to take the price off of the cans and then stamp it on with a hand stamper. And that was going on quite a bit. Sometimes, every couple of weeks we'd do it again, and even less. And the same thing with little white stickers that you put on. So, and we never really kept up. So the stagflation we're having now is more pronounced due to the huge government deficits and because of personal debts. And so to borrow a term, it'll be on steroids. It's already on that. We're 7.5% on the CPI, came in yesterday. The reality is, on the shadow stats, is probably twice that. If you go to the grocery store or you go to the hardware store, try to find something that has only gone up 7% this year. I think you'll be hard put. Everything I see is 10 to 15% or 20%. And really, the retailers don't even know what the price should be. They just say, well, let's raise it $1. And they're not trying to gouge people. It's just that they don't have a way to understand really what it should be. And we look at the CPI all the time. That's the government doctored figures. But I like what Frank Holmes says about it, how he discusses it. He says the CPI, the Consumer Price Index, is a backward-looking index. The Producer Price Index, the PPI, is a forward-looking index. The PPI is what producers think and distributors think is going to be happening, and they tend to be pretty accurate. They tend to be more accurate. And so I would suggest pay more attention to the PPI if you want to know where things are headed over the next few months at least, than the CPI, which has you looking in the rearview mirror in your own personal and investment planning.
So the difference again between the CPI and the PPI, CPI kind of looks at a basket of goods and the government says, okay, these have gone up so many percent since a year ago, right? But the PPI is actually looking into the future and projections for that. Is that what you're saying?
Right. And the CPI is evaluated every month. So, you can establish a trend one way or the other by charting it like you would a price. But I mean, it comes out every month by the government. And, people kind of hang on that thing. But again, the important things that you and I use on a daily basis, a lot of those are not in, or they're in the index, or they're factored in one way or another. And there's even something called hedonics, hedonics, which is kind of silly. It's like if something is made to be more efficient, like if a computer is a little cheaper because it's more efficient or moves faster, then they'll change that metric rather than the fact that it might have gone up at a certain price. They try to make it look a different way. And so all this manipulation just ends up with a bunch of stuff that's not very clear. So the thing is, if you need something, buy a little ahead on it, and more people are going to start doing that. And then finally, when they panic, then they stand in line to buy what few things are left, and then you have something that moves into very high inflation and potentially hyperinflation at some point going forward. And that can happen very quickly, and it can be unpredictable, as we've seen in Lebanon, Venezuela, Argentina, which is now over 50% a year, Mexico even. Mexico is being hit by a double whammy. They have the inflation that we've discussed, but they also have lost about 25 or 30% of the peso in relationship to the U.S. dollar, because the dollar is stronger than the peso. So they're getting whacked in two different directions. And ultimately, that causes social unrest, especially in countries where a high percentage of the income goes to food. And if it goes up 10%, that's a huge, hole in their budget. Whereas for someone in the middle class, say, it bothers them, but they're not going to have trouble putting food on the table and gas in your tank.
Now, if we do look at the difference between the CPI and the PPI, it's pretty dramatic, actually, because what we're seeing right now, the Producer Price Index is showing nearly 10%. It's 9.7% inflation. And this was just released, I believe, yesterday.
Yes, you're exactly right. And that shows you, I think that demonstrates visually why we should be paying attention to that. If you want to know where things are going, and plan for that rather than reacting. So this is proactive in your personal and investment planning versus reactive. And I do think that gold and silver would be stronger if people weren't pricing in the potential for interest rate increases as though that is going to hurt things. I remember when gold and silver went through the roof in that late 79 and early into January when they topped, we were looking at 18% interest rates. So, it's about market perception, but it's also about reality. And I wouldn't be worried too much that inflation that interest rates are going to go to the point of harming or blunting an impulse leg in the metals. That's way down the line, and you shouldn't worry about that. The pressure that's building up is like a pressure cooker, and when gold and silver are ready to rock, which I think they're getting closer and closer to, they're not going to ask themselves what's the inflation rate, and the Fed's not going to be able to go a whole lot higher anyway. And the first time the stock market starts dropping 10 or 15%, they're going to fudge back on it like they did in 2020, March 2020. So, just be proactive rather than reactive. Keep your eye on that PPI. And
one way to protect against inflation is obviously holding precious metals. the interesting thing is it matters even if interest rates rise. What correlates most with the gold price correlates negatively is not going to be inflation, but it's going to be real interest rates. So as long as inflation stays above real interest rates, that should be bullish for gold, correct?
Absolutely. That's kind of a big metric. I mean, it doesn't mean that if the two ever met that would be the end of the market, but it means that there's more power behind the driving gold and silver if real interest rates are lower, than the inflation rate. So let's say if we had inflation at 7% today, let's call it 7%. If interest rates were 9% or 8%, that would mean people could do well to buy interest-bearing instruments. But now, because interest rates are under 2%, and then in your bank account, they're like a fraction of a percent, 0.5, 0.6%. So in your savings account, 0.6 versus 7.5, you're losing about 6.8% per year under the government's stated guidelines. They're actually on purpose, taking away your purchasing power. That's not a good math problem.
Well, David, we really appreciate all your time today and your insights. Before we let you go, did you have any last thoughts for our viewers? And where can our viewers find you online?
Well, I contribute monthly to the Morgan Report and to Money Metals. And also, if they'd like to look into the idea of digital silver, which David Morgan and I have been involved with for going on 5 years now, where you can buy metal, some of your metal, to store digitally, they can write to me at AG, or they can go to ag.lode.one.
Fantastic. David, once again, thank you so much for your time, and God bless.
Thank you for having me back.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.